Bitcoin's heading to $170,000 and ETH to $20,000. Those aren't my words. They're coming straight from one of the most bearish macro analysts in the world, who just flipped MEGA bullish and is now loading up on altcoins. But here's the catch. Henrik Zeberg, head of macro economist at Swissblock, and one of the few analysts who correctly called the 2008 Great Financial Crisis, has built his reputation predicting market collapses and warning of depression-level crashes. But today, he's making a shocking call. We're headed into a euphoric melt-up right before a 2008 style crash.
We are in what I've called a blow-off top, in where we're going to go exponentially higher. Bitcoin 165, 170,000 easily, as I see it. Ethereum, I got, I think it's around 17 to 20,000. I think we can hit that with Ethereum.
He has receipts to back up his claims. Henrik's models are flashing the same signals we saw just before the great 2008 financial crisis.
It's actually completely comparable to what you saw in 2007.
And yet, he's not sitting out. In fact, he's positioning aggressively.
I'm long crypto right now. I'm long some of the most shitty coins you can find, which I think can have an explosive development.
He believes this cycle ends in pain. But first, a surge that could push the whole crypto market 3 times higher. And yes, alts, a lot more than that.
The total size of the crypto market that I'm looking into is around 12 to 13 trillion. So we are by no means close to this.
And he's timing it around the Fed's next move.
I think we are seeing the Fed coming out and actually understanding that in September. And I think they're going to do more than just the 25 basis point. I think they're going to do the 50 or something, or even more. And we're going to see the market just reacting like, boom, straight up.
If you want to understand how to ride the most powerful crypto rally of this decade and not get crushed in the collapse of what follows, this might be the most important conversation you hear all year. Guys, this was an incredible conversation. I was so happy to have it. It is eye-opening. And guys, of course, you must be following Henrik to get all of his latest macro calls. I will leave his links down below. Without further ado, let's welcome Henrik to the stage. Henrik, welcome back to the show. Good to have you here again. Right now, everybody is feeling extremely bullish. We've seen ETH absolutely ripping. Today, at the time of recording, Bitcoin is getting a nice little pump as well. And we see things that typically show us all the tailwinds. We've got crazy corporate treasury buys of Bitcoin and Ethereum, a little bit more and actually a lot less in things like, but at least something in, XRP, Sol, SUI, these kind of things. Where are we in the current market? Are we still headed in this 4-year kind of market cycle? If that's the case, when can we expect to see the end? Just kind of where are we?
Well, so we are in the most interesting phase for any crypto fan. I'd say, we are in the old season, in the early phases of, you call it the ETH season. I agree with that. But we are in the phase where Bitcoin starts to have, the Bitcoin dominance starts to decline. And first, because capital is being attracted into Ethereum, and then we'll see that move. And then most likely we should also then start to see the large cap coins, tokens start to move. And then we'll see, down the road, I think we're going to see also the memes. So in that respect, we are in the most interesting phase. We are in what I've called a blow-off top, in where we're going to go exponentially higher. Bitcoin 165, 170,000 easily, as I see it. Ethereum, I got, I think it's around 17 to 20,000. I think we can hit that with Ethereum. So we are in a very interesting phase. And we'll see a lot of that capital start to rotate also later on. So in a good phase, and what we've been expecting. But here it is. Still some doubters out there. I think it's gonna move very quickly higher in the next coming weeks.
And so, with that being said, are we in kind of a different cycle as far as the 4-year cycle with all these kind of institutional tailwinds? I just saw today that the probability of the Fed cutting rate in September has jumped to like 99.8% or something like that. So, that would be the beginning of lower interest rate era. And what we're seeing as well with, US and global M2 seems to be skyrocketing. We see central banks in other places in the world cutting rates as well. And, we've got a lot of things from the US administration, like the big, beautiful bill, raising the debt ceiling, money coming in, Trump coming out and saying, that things are going to be explosive over the next 6 months or something. I mean,
what's not to like? If that's what you're saying, what's not to
right?
like?
It sounds like rainbows and sunshine, right? Is that what we are looking at for the next few years?
But that's the problem. That's the problem. We always talk about that. There is we need to see the market actually rising and defeating the doubts in the market and the wall of fear and all that. We hear the talk of that, and that's what we've seen with Bitcoin actually doing all the to talk. Now everything is there on the table. And then you see the market move, and it can do that for quite some time. We can see the rotation of it. Bitcoin has been attracting all the capital in. But yes, to me, we are in a different phase. And the top, when I talk about the blow off top, this is not based on crypto. This is based on the business cycle that I study intensively, which is telling me that we are getting to and I was not there in 22 and saying this was a recession. I was not there in the banking crisis, and that was when we had the inflation spike. I was not there in 23 saying that. I was not there in April of this year saying that. What I am saying is that now we're getting closer. And the thing is that we have an economy in the US that is actually starting to stall. And you're right. We then get the central banks coming in, and the ECB and other central banks have been in there for quite some time. And you could say that's great. And that isn't what we hear every time. We hear that, now they come, they will make sure that things are not starting to unfold in a negative way. But unfortunately, that's not, liquidity cannot stop the business cycle. And again, we just have to, I mean, there'll be a lot of doubters to what I say here and say, Henrik, you don't know, and this is different and all that. When I look at it, and you can look in history also, and I have a nice chart I can show you here as well, liquidity cannot stop the business cycle. And if you just bear with me for a second, if you want to see it, Kyle, I can just,
please.
Let me just do it here. Yeah, let me just share my screen here, share screen, and we do like this. And we go to, let me see this one. So this is the dot-com crisis, and this is the great financial recession, or the financial crisis in 2007 to 2009. And here you had the liquidity, the M2 you were talking about, for the Fed, the ECB, the People's Bank of China, and the Japanese central bank, also Bank of Japan. And you see how it's rising here. It was not so strong here because also there's a more shallow recession actually we had. But you saw the stock market. It dropped a lot, by 50%. And even the NASDAQ dropped by 85%. See, this time we into the financial crisis, it actually rose much quicker, the money supply. But you still have a recession. And the thing is that when the business cycle, which I follow, which is here, you had a signal right here for me, and you had a signal here, and I can show you that as well. This is the business cycle I'm talking about right here. This is from early July. Every time for the last 50, 70 years, actually 70 years, but here we only got 50 some years. Every time my leading indicators has been rolling over, you get a rollover of what is called a coincident, which is employment, manufacturing level, and so on. And I've said a long time that when we get this crossover, and we did that in November 24, that's this time when the countdown starts. If you go back to the financial crisis, you actually had in November 2006, you had the same kind of crossover. The recession didn't start there, but it led to the crossover of the coincident indicator, which was in November 2007. And the recession started then 1 month later. Now we have had this crossover some time ago. And if we go even further in and look at that, we can now see that with the down revisions on the revisions lower of the non-farm payrolls, we now have the touchdown of the coincident indicators, which is the same thing we have seen here, here, and here. And if we go back in time and say, oh yeah, but then they will make sure by liquidity, making sure that this is not going to give us a recession. Well, I think we'll have to face that this time will not be different. So I think, unfortunately, we are in a situation where everybody will think that the Fed can change the rule, can change the path of the economy. And that's unfortunately not how it works. That's the talk of the town. But the problem is right now in the US and elsewhere also is that we have had inflation. We have yields moving up. So people are up to their necks in terms of, just paying bills. You can see there is also some surveys on people actually, just having difficulties in buying food. Yeah. That level is now at 15.6%, which is higher than into the financial crisis. So this is not a situation where people are feeling good in the US or elsewhere, I have to say as well, because of the high yields and because the US is just still the big brother of the world, that, anywhere the US goes, the rest of the world goes. So if you see that, you'll actually see that the real economy is stalling. And we saw that with the job numbers also. They had to revise the May, June, and July, and the July number was also really bad. So if that rolls over, as according to my business model, unfortunately, there's not much we can do. And now we have the euphoria, which we have because liquidity is starting to flow in. The M2, as you correctly said, has been going up, and that will create it until the moment that reality, which is the real economy, unfortunately hits the wall. And I think we are really close to that, which means that the crossover here needs to be confirmed by end of September. And if it does, that's the time to move out of markets, as according to my model.
What's the underlying cause of that correction? It's, is it basically the fact that the majority of people just can't afford to spend anymore, and so therefore you're going to get a slowdown in earnings and revenue across all the major companies and just essentially restaurants and all spending in general? Because I think in the show that I made yesterday or something, we also covered that buy now, pay later has gone through the roof. Personal and median household debt is increasing. Credit card debt is still on the rise. So these things all seem to kind of line up with what you're saying.
Yeah, we have exactly that situation, and I have yet another chart I can show you. But you can look at the delinquency rates for credit cards, for car loans, and whatever. They are moving up, and they are moving up in a similar manner like what we saw into 2008. So the situation is not what was it? What is it that what is the triggering factor? It's like one thing. That's how the human brain likes to work. We need to have one thing because that's what we can remember. The situation is in the real economy that it's a plethora of different things that's happening. It's really about the bottom part of this, the real consumers, the 70% of the lowest income. And when they start to feel, difficulties of just making ends meet on a daily basis, they'll stop spending. And that is then slowly seeping into the rest of the economy. And then especially at times when you have, like in the US, and again, you live there, so you know better than I do, but I'm looking at the charts and the numbers. You have a housing market right there now, which is frozen solid. Yeah. The number of mortgage application is down the gutter. The housing affordability is down the gutter, which means that people have been struggling to refinance. That's okay. You can live with that until the moment if you start to lose your job. And unfortunately now we start to see that development in the job market. It's actually completely comparable to what you saw in 2007. So, and that's on top of this time around, because in 2001, we had a tech bubble. And in 2008, we had a real estate bubble, and we had what is called a balance sheet recession. This time around, you have the largest bubble ever. By the Warren Buffett indicator, you say market capitalization to GDP, it's 226, 30% almost, if you include also the crypto market, 230%. In 2007, it was at 108%. In 1929, it was at 89%. In 2000, which was the huge bubble we had back then, the tech bubble, it was at 136%. We are almost, going for double the size of the tech bubble. That's what we're closing in on. Not really there yet, but we're getting in there. So I'm just saying, let's not fool ourselves. We have an economy that is not strong, and it's slowly starting to seep in as well, also to the Fed, it seems. But they have been agreeing with Trump there. They should have cut long ago. There's no inflation in the system. The problem is that has not happened, and we are now heading towards that wall, unfortunately. I don't hope it's happening. I hope I'm wrong, but I just don't think I will be.
What about the things that Trump is talking about? The fact that he says he's brought in, I don't know what the actual number is, but I think I heard him say that he was brought in $17 trillion in foreign investment in the United States, that they're bringing all these companies back on shore. Do you think that something like that could change, because that's going to lead to new job growth and creation. I don't know how quickly they can convert that money into actual numbers, but
correct. Yeah, but I don't know. I don't know how much he has been able to bring in if these investments are correct or anything. I'm not arguing with that at all. What I'm saying is that we have a situation that is unfolding right now. And the problem is with the Fed that the moment they're just sitting and waiting for, if something happens in the job market, we will be ready to act. Guess what? They were standing there on Wednesday talking about, oh, we need to have a kind of a hawkish stance. And on Friday, the Friday after, we actually saw that they had to revise the numbers going all the way back to May. They are not on top of their things. They're not on top of the game. They don't see this. And the problem is the job market starts to move before. And it's like with a super tanker. When it turns, it takes quite a lot of momentum to turn it the other way. So you can easily get 3, 6, 9, 12 months worth of really bad times, because that's what it takes for when the super tanker turns. And it is turning. It's really clearly turning. As you said, also, the other central banks of the world have been there, already for a long time. There's such a divergence between what you see in the ECB, who normally are very, very conservative. We have to think about, because of Germany's past with the hyperinflation in the 20s. So they are really conservative about that. And actually, the ECB is way, way ahead in terms of cutting rates compared to the Fed. The Fed has been, as I said along, they are so far behind. It's unbelievable. And and the problem is it's going to hit like a hammer. And when they see it, it's too late. And the market will have topped into a blow-off top that I called, which I think we are seeing right now as developing. Unfortunately, not much to be done about it. If the jobs comes in with investments and so on, fine, great. But as you said, it takes a while. And by the end of the day, it's really about what the consumer is doing. Because if the consumer doesn't spend, it's not like a lot of businesses just will say, oh, I want to build new business. They will look at what is the market demand there. And then they will start to invest in a certain direction. But if the market demand is pulling back because of the situation with interest rates, inflation, and so on, well, then we're heading into bad waters, or we're actually sinking, as I see it. And I think this time is different. This time is different. Normally, I mean saying this time is not different, because it's never different. But different in the way that if we look to the inflation regime, and I actually also have a chart there, and maybe I can just find it here. Then okay. So this is what we're looking at here is the 10-year yield. It's going all the way back to the 1920s. And if you look at it here, we have moves up and we have moved down. We have moves up and down and up. What we're looking at is that for a certain amount of time, you'll have a deflationary regime. That means that everything is pushing down lower in terms of yields. And you can actually observe that for as long as we're down here in momentum-wise, well, inflation is low and yields are pushing lower. Then happens when you see is that shift here, and it moves up to a higher level here in the green area. You can definitely see that that's going on. A higher shift here, and then you just stay up here. That's when you have an inflationary regime. Then you see the crossover, and we stay down in this area here. Then we have had a long-term deflationary regime. With what we saw in the 2020 with Corona and with every central banks of the world and administration coming out and stimulating into a supply chain crisis, well, that created a new inflation. They reintroduced inflation. Mm-hmm. And that's why we now see clearly here, if you can see, we're now moved up here again. We're moved up in this upper area again. And that is a very serious thing. That means inflation is in the long term, and that's like also what Gauntlack and others are saying, we will have rising yields, a rising inflation. So where we need to be careful, understanding is that if it's going to look something like this potentially, I don't think it's going to go straight up, and I think a recession is going to take it down first. But I think the new bull trend in inflation and in yields has started, and that's why I'm saying it's a completely different situation this time. Because if you're in that kind of environment, you can just go back and ask our granddads and say, "Hey, granddad, what happened? What happens if you are stimulating the economy? You're just coming in with a lot of money printing." They will say, "You get inflation," because that's what they saw in the 70s. Well, we have that kind of environment now. So if we're thinking that Powell can come out and say, so why just wave his little magic stick and say, I'll just print some money, or do QE or whatever they're going to call it, you're going to get another situation. You're going to get inflation. That is the way the economy reacts, because it's not just a single state kind of thing, and it reacts the same way. it can shift gears and it can shift into a new, and we are new in a new inflationary regime. And that new inflationary regime will change the game for the central banks. They simply overdid it with money printing.
Yeah.
And that means that now we are in a situation where that is a problem for us because they've now been taking that tool out. The free lunch is taken away from them. And they cannot just any longer do that. I'm sure they will try to, but I'm also sure that they're going to get another result. And unfortunately, I think that's going to prolong the crisis. So in an inflationary regime, in a crash first, and then the Fed comes in, and you don't get the kind of response from the economy. And you can also think about what happens if Fed comes out and do the money printing. They try to lower yields. Okay, let's say Mrs. Johnson there in the US, she saves, I don't know, $300 a month on her mortgage loan or something like that. I don't know what the level will be. Will she then, with everything she has now in her back head in terms of inflation, in terms of yields, and in terms of potentially also unemployment moving up, will she go spend that money, or will she maybe hold back on it? If she holds back, the money printing, the QE becomes impotent. It doesn't work because the thinking is she spends it, then somebody has to go to work to produce that, and then he earns money, and then you have the positive cycle going. If that slows down, which it already has, we can see that the marginal output of any extra money printed or balance sheet raised, you can see that has actually produced a less output. If that happens and it slows even more, well, then you're not going to get that positive response, and the economy will then slow for longer. So I think you're going to see that the Fed will come out, but it's not going to get the response that they probably hope for. And that's the problem this time around. That's why I think it's different this time.
But isn't Bitcoin supposed to be the ultimate hedge against inflation? And wouldn't that even make the saying even more true that Bitcoin has no ceiling because fiat has no floor?
But how did Bitcoin do during the inflation spike in 22? It dropped from 65,000 to 15,000.
Right, but we were in a different environment then too. We had zero institutional adoption, more or less, no ETFs, no corporate treasury buys, and no idea that there potentially would be a world reserve asset or treated as such. So do you think that, like, I understand that a slowing growth cuts consumer spending, not good for business, but Bitcoin doesn't rely on business, right? It's it's a different kind of asset, supposed to be. It's been heavily correlated to the S&P and stocks to date, essentially. But I wonder if eventually it will become less of a risk asset and more of a store of value kind of asset where, so I'd like you to answer that question. And then if it's not Bitcoin, like where does, let's say that everyone's able to accumulate a good amount of wealth over the next, couple months or something like that, because we are seeing this crazy bubble, as you're saying.
Mm-hmm. Mm-hmm.
The next question is, where does someone allocate to?
Yeah, but let's do, if people are saying that Bitcoin all of a sudden has changed behavior, well, we don't see that yet. We see that Bitcoin is overperforming NASDAQ to the downside and to the upside. I don't see Bitcoin as there's any behavior in Bitcoin here apart from the narrative that tells me that there is a new behavior to Bitcoin. I hear the talk of it, and that's what you hear in bubbles. You hear the talk that this time is different, but you don't see it. You see Bitcoin doing really well when the NASDAQ is doing well. That is the correlation between the two is just phenomenal. So I don't see it. I see people talking about it, but as we also started out by saying, all the good things are now on the table. Yeah. I can hardly imagine any more tailwind to it. Yeah. So would we expect if I'm right that we're heading into a major top, and by the way, also the Bitcoin cycle top, a 4-year cycle, right? That we see all of a sudden that Bitcoin breaks out of all of that and starts moving up? Or will we see Bitcoin crash? And unfortunately, and I'm not pro or against or anything like that, I'm just saying, I think Bitcoin is going to crash harder than it's done before. And I think that because this time around, you actually get a recession. You get a balance sheet recession. You get a recession we haven't seen before. Bitcoin hasn't seen a recession before. but the Nasdaq has seen a recession before. And if Bitcoin acts like Nasdaq did in 2000, where Nasdaq fell 85%, and we have a bigger bubble this time around, then you can say Bitcoin is outperforming Nasdaq to the upside and to the downside. Why would I expect, from what I see right now with the facts on the table, that Bitcoin would outperform the Nasdaq? I don't think it will. Yeah, it will outperform it to the downside, I'm afraid. So I think we got a massive decline coming. I don't hope for it. I don't want to, the discussion with any diehards on that. But I can just say I don't see the writing on the wall in terms of the facts we have in front of us telling me that this time will be different. So where do people go? Well, there's one thing that will be in the need of. That will be dollars, US dollars, because US dollars is where the main part of the world's debt is denominated in. So what happens is that you will see first a suction hole opening up if this bubble bursts, meaning companies will go bankrupt, there will be dominoes effects and so on. You've got a credit events, and there will be a suction effect. And to cover that, that will be needed dollars in order to make sure that loans are refinanced or closed or whatever it is. US dollars. And I know that's not what people like to hear. But the fact is the US dollar has been in an uptrend since 2008, since they started the QE. It's not been in a downtrend, it's been an uptrend. So I'm just saying, I think the business cycle is going to tell us we're hitting the wall soon. Not here yet, still seeing the explosive move in this. Right around the time of the 4-year cycle, I think we're going to see a major top. And I think it's going to create a suction where the US dollar is going to be very, very strong. And for some time, there will not be many alternatives. Yeah, there's probably also a reason why some great investors are starting to say, well, maybe we should get out of risk assets. Warren Buffett is up at 30% in cash right now, which is higher to his assets portfolio than, with cash-wise than he's ever been before. Maybe there's a reason for that.
How long do you expect the crash to last?
I think the Fed is going to react again. Right. And as everybody says, Henrik, but you don't understand. The Fed is going to react. Sure, but you are in a different environment. And I unfortunately do not see any signs that the Fed has learned from anything or understand this. I mean, they did not see inflation coming. They did not see the last big recession coming in 2008. I mean, and they don't see the problems in the economy right now, and they still are hawkish on it. So why would I expect that they all of a sudden, get their things right? I think they're going to try to react in the way they normally do and say, hey, we get a crash, we can put some money into it. By the way, I mean, Bernanke, he got the Nobel Prize for understanding printing money again. So I don't think you're going to see that they're going to react anything differently from that. So they're going to throw money at the fire. The problem is, this is a new inflationary regime. So I think they're going to also, because you don't get this, if the Mrs. Johnson there doesn't start to spend the money she saves, well, then you can get that it's a prolonged crisis you're going to see. And I think they can probably even trigger stagflation, which will be worse. So I think you're going to see a kind of a whipsaw. You're going to see the crash. You're going to see the Fed come in. Everybody thinks it's fine. But I think you're going to see stagflation. And there's no doubt in my mind that no risk asset is going to like stagflation at all. That's going to be a bad time. I mean, that's where, activity is shrinking while you see money going, the prices going up. That's not good for any risk asset. So I see that we have a very difficult situation in front of us. But hey, who would have thought that money printing would come to something bad at the end? I mean, if it was so easy, why wouldn't we see, politicians, central banks and so on have done this before? Say, hey, we just need to print money, then it'll all be all fine. Guess what? It has happened before. And every time they've done that, we've seen the problems coming out of that. It started all the way back in French Revolution. The French, the French did that back then in those days, and you got inflation coming out of it. So of course you're going to get inflation, and inflation is going to be born maybe in a stagflationary environment, and I think it's going to be bad for all risk assets. So how long? I'm saying, the first decline can be 9 months, 6 months, 9 months, depends on when the Fed really enters with something. We get a bounce in the market again, bounce in Bitcoin as well, and then you're going to see the bad one, which is when stagflation begins. So I think it can be a prolonged thing. Think double this, twice as long as the financial crisis or something.
So, what's your plan?
My plan is to ride this. Yeah.
Yeah. And yeah, sorry. What's your plan, and when do you? What are you looking at as far as your exit signs?
I'm long crypto right now. I'm long some of the most shitty coins you can find, which I think can have an explosive development.
Yeah.
I am long Ethereum holding companies as well. I think they can do fantastic here over the next few months. I am aware of the situation, and I am ready to pull out when I think we're gonna hit the top. I have some Fibonacci levels on my technical analysis that I look to 7,500 on the S&P, and I look to, but it's actually across the board. There will be a lot of targets that need to be reached, and then I'll be looking for when we start to see the reaction in the yields market, and the yields market will actually not be going up. It'll be going down, and when the short-term yield starts to drop fast, that's a tell sign that things are starting to unfold. And we are getting closer to that point. I know people talking about the long-term yields. That's because, again, in the business cycle, long-term yields are lagging the business cycle, which means that what they see in terms of those is what we saw in the business cycle 3 to 6 months ago. And the economy was still strengthening there and still strong. Now we're going to see something different. So that's why I'm looking out for the yields to start, the short-term yields to start to drop fast, yield spreads starting to spike. And the initial claims on the job market start to spike up. That's the moment where I think the economy is close to. But in terms of I think the Bitcoin cycle, whenever that top is due for, I think that is a pretty good time indicator for when this can start to unfold, when the top will be there. Remember, nobody actually at the top will feel the top. And any pullback in the beginning, 5-10%, people will say, oh yeah, but that's just a pullback.
Yeah.
And it'll come up soon again, and then it'll bounce, and then people say, "Oh, now it's bouncing, and we're getting to new highs all soon." And then it'll just be later. So it can go 6 months before people really realize that this was the top, right? So I think around the Bitcoin top, Bitcoin cycle top, where it's due for, then I think that could be around the time where we should look to look for the exit doors.
And so you said you have some like Fibonacci numbers in mind. Is that what you're looking at? What do you expect the top of the cycle for Bitcoin and Ethereum to be?
Around as Ethereum around 17 to 20,000. I think 17,000 is a bit, so it'll be like an explosive move here, and it actually goes really well hand in hand with my 170,000 on Bitcoin ish area, because there is also the ratio which seems like it can move to 0.1, the Ethereum Bitcoin ratio. Around 7.1, maybe 7.12. So that means around that area. And when we're there, make the best of it until that right. moment, because we know it's a zero-sum game. It's a zero-sum game, which means that there will be a lot of losers in this, unfortunately.
So, all right. So now let's get into discussing like what the next couple months look like and how we maximize that. You said you have a lot of shit coins and some more more risky assets. How do you make your decision on which one of these ones to go into, and you think that will perform the best?
Again, based on Fibonacci levels, LE wave analysis, how far do I think they can run, and then I stick to it. So I say I kind of memorize that chart, in and out, and try to see if it can also make the hypothesis of how it will going to develop. And there are some Fibonacci levels that when you start to see that it's actually obeying these levels, meaning that there'll be a kind of a correction there, and then the next level there, and the corrects there. Well, then you can start to trust that level. And then I have there are certain that I hold and will see how good they run, how far they if they can actually get to those levels. But this total size of the crypto market that I'm looking into is around 12 to 13 trillion. So we are by no means close to this, and this is where it's so difficult to talk about something that is so much higher than where we are now. We were at 3 trillion until that was the top in 21. Now we just about 4 trillion, I think, and right about around this time. 4.2, and talking about 12. Yeah, but the thing is, it can go so quick, and the last phase of this can be so fast. And I don't think people really realize how fast it has happened before, also, and especially because this time around, actually, to me, and also to my very experienced crypto colleagues in Swiss block, it actually seems like it's a 2017 kind of event more than it's a 2021 kind of scenario we are unfolding.
Right. Which, if anyone was around in 2017, that was a very fun time to be in crypto.
You were there.
Yeah. Yeah.
I was not.
Yeah. It was wild. But that seemed to last a little bit longer than a couple months in that kind of very euphoric phase.
Yeah, it did. It did. But if you look into the last few months of that, I think there is a 400% something on the altcoins in 2 to 3 months, and I think that is what we can look into. I mean, that's the kind of the size we need for the crypto market to reach that kind of top. But it also has lasted. I mean, we could just look at it. I mean, the bottom in Bitcoin was in was it in December or January? December of 22, right? Was maybe correct me somewhere around that.
Yeah, that was the bottom. That's FTX. Yeah.
So we have been on this journey for quite some time, and now Ethereum starting to catch up, and it's moving quite fast. So I think the catch up can be quite rapid here, and I think the rotation into other coins here will also start to happen. You'll see some of the bigger ones, there's large caps, and then you'll see the next one coming, and by the end of it, it'll be all euphoria. And so I think it. But again, time-wise, I'm looking for the levels in terms of various Bitcoin and so on, and the structures start to develop. And another thing on Bitcoin, I just have to say, if anybody looks at a weekly chart and you don't know anything about technical analysis, and you look at the divergence you have on a weekly chart, it tells you that we now have been going on since March of 24, and we have not seen a new high on the RSI. Actually, the RSI tops are lower and lower, and that means that we are not seeing a strengthening market. Despite all the talk of that, you are technically seeing a weaker market, but you're seeing higher levels in a weakening market. I know it can be difficult to understand, but the force of the current in a river is not as strong as it was in 24 into that top. It has been weaker, but the levels are higher. And that's simply because people take on more risk, but there's not as much force behind it as it was into 24 of the March top. That is also noticeable because that was a lot lower than where we are now.
We've seen, I guess, over the past few weeks or the past month or so, Ethereum really has dominated. So we see, I'm looking at the chart now. The past 30 days, Bitcoin has completely stayed flat. ETH is up 53%, and of the top 100, nothing really. I mean, Athena has outperformed, but mostly Ethereum outperformed altcoins. And I think that Ben Cowan showed a really cool chart too. Being explicitly clear that we're in ETH season, not in alt season right now. How much longer do you expect us to be in this ETH outperforming alts until we see that real rotation into alts where it starts out? They start outperforming ETH.
So I think we have I'm working with a timeline that's saying around 10 weeks, so it means until the end of October. That's a lot of things that's suggesting that could be kind of the timeline. And I'm looking also at a chart where Ethereum with the current Fibonacci levels is going to reach around 6,400. And we're going to see a pullback from there. And I think you're going to see a quite strong pullback. So in September, when you see a pullback, I don't think that's it. I don't think that's the top. I think that is the pullback. But I also think we're going to see I'm speculating here that we actually are in the days here of the most powerful move in Ethereum, actually, because we have seen that already. But going into, let's say, Jackson Hole, which is on 21st of August, I think it is. We have the Powell and the rest of the gang. Sorry?
Yeah. The SALT Summit? Is that what that is? Or no?
It's called Jackson Hole is a yearly summit that meeting that they have with the Fed, right? And that's I think they normally come out and have some kind of announcement around that. And I could see that we actually move fast into around that timeline. And then I could see the decline, perhaps maybe as a narrative, starting out perhaps from around that time frame, and then into the FOMC, which is around September, where we could see the Fed coming out and cutting. And I think I said it also on Twitter a week ago. I said I think the Fed is going to go do a double cut, at least 50 basis points. Now, whatever they said the other day. Now everybody thinks if it's 25 is there, but it was doubtful even just a week ago, right? I say 50 basis point already 2 weeks ago. And I think I did that because I think the Fed is starting to realize how far behind they are with the numbers that we saw on the job. They are actually looking at historic numbers now that is really bad. And even the July number can also be revised to the downside. And we have no inflation. There's no inflation in the system. I mean, whether it's 2.7 or 2.0, Honestly, that is not the problem. The problem is if it starts to go above 3.5, 4%, 5%, that's a problem. 2.7, we have been in great periods of time during history where you have had 2.7% in inflation, not a problem for the economy. So talking about micromanaging the inflation level around 2.7 is simply, stupidity to me. So I think we are seeing the Fed coming out and actually understanding that in September. And I think they're going to do more than just the 25 basis point. I think they're going to do the 50 or something, or even more. And we're going to see the market just reacting like, boom, straight up. So the straight up phase, and now back to your question, because your question was when then the real alt phase.
Right.
From that point on, I think that's the trigger. And I think the narrative then will be the Fed's got our back. What can go wrong? They can just print our way out of it. And as we know from the first chart I showed you, they cannot. But that will be the talk of the town. And that's why we're going to head into the stratosphere with a lot of altcoins and meme coins and so on. And the rotation will just, go crazy.
Henrik, so I think, obviously, we're going to leave your social links in the description below. So everyone make sure that you guys go follow Henrik as well. But for those who are watching this, who want to stay on top of things themselves and not always, go and look at other, people's X accounts or YouTube videos, who really want to kind of try to get a hold of this, like where do you recommend that what are they looking at, to try to figure out and see? I mean, is this something that someone who doesn't have a lot of experience with charts and stuff like that can actually, what are some good resources that they can look at to see kind of to gauge when we might be looking to kind of call it quits or, take profit into cash at that point?
I mean, first of all, just feel the sentiment. If you feel like that you hardly can say anything negative about crypto or Bitcoin, then probably it's because, everybody you're standing in the same side of the boat like everybody else. And when everybody's already over there, maybe it's not the right place to stand. I'm not saying that's the situation right now. It's building, but we're not there. But feel the sentiment. That's why also we have, when there's blood on the street, buy, and when there is, euphoria, sell. Look to what Warren Buffett has done. He's raised the most capital ever. 30% of his assets is now in dollars. Why? In cash. Why? Probably because he sees something. But he doesn't understand it. Well, we actually are looking into a slowdown of things. So I think sometimes you actually need to do the work. You need to look for yourself. If you trust somebody, if you trust you, me, somebody else, fine. But we can be mistaken. The best thing is to go and look yourself. And I think the writing is on the wall, and it's about taking a good hard look at it and not go with the euphoria. And then just stepping back a bit and say, hey, if I have to use the quote, this time is different, to actually understand what is going on, then, and to understand the bullish case, well, then maybe I'm in the wrong side of the boat. And again, I don't know who to follow. You can follow me or anybody else, but I would be careful into this. But I am, as I said, crazy bullish here. I don't want to make any mistake, on this. I'm crazy bullish right here.
Okay, cool. Henrik, is there anything else that you think we should cover that we haven't yet?
No, I think good talk. And again, I don't want to be the bearer of bad news. Let me just say it like that. I'm not a perma bear. I can tell you. I think last time I was on, I was also saying I think we're going to get into this kind of phase, and we're going to see. But I am realistic, so I don't like to be the bearer of bad news.
Well, I think it's a really, really, really important that we have some sobering discussions in the time. Especially, I'd love to have you on like at least once a month moving forward, so we can update this. Because, I've said it many times on the channel before, is when you get into this very euphoric stage and your portfolio is crazy and you're just showing it off to everybody and, and you just feel so rich, that moment in time is what we all look back on who have been here multi-cycle and just think, man, this time I should, take some profits up there. And I also think it's worth saying that, people should measure who are here for multi-cycle, measure your net worth and your portfolio from trough to trough, not peak to peak. Because it's not about how much money you once had; it's about how much money you can keep in these crypto cycles. And so,
I agree.
I think this, for me and my viewers on this channel, it's very important that we continue, no matter how good we're feeling, how euphoric we are, to always have a reality check and make sure that we're looking at these other things other than just what digging past the surface and looking at the business cycle, like you say, and earnings and what's going on with the real data. So, Henrik, thanks for the video. Really, really interesting. And we'd love to have you back on next month or something.
Thank you, Carl.
Thank you.